Hey there, welcome back to Great Quarter Guys, the show where the lines between freight and finance are none. I'm your host, Andrew Cox, and senior retail analyst here at FreightWaves. I've got JP Hampstead with me, the director of Passport Research. We're going to be covering brokerage earnings. We're going to try to dispel whether or not we believe 2021 will be the peak year for brokerage earnings. We're seeing a lot of great numbers. We're seeing the stocks up near all-time highs or just under them. So there's a lot going on in the brokerage space. We're going to dispel some of that through the earnings of some of the biggest players in the industry. If you're watching live on FreightWaves TV or FreightWaves LinkedIn, welcome. Thanks for joining us. And if you're listening on demand, remember to subscribe to Great Quarter Guys wherever you are listening, Apple Podcast or Spotify. And you can also subscribe to Freightcast, which is our all-in-one feed, everything that we do from an audio podcast standpoint, all in one feed. You can also get that wherever you listen to podcasts. Before we get going, I would like to take a moment to thank my sponsor of this episode. This episode is brought to you by DDC FPO. DDC is a business process outsourcing provider that specializes in freight, perhaps best known for freight billing. DDC recently launched IT outsourcing to help supply chain stakeholders hit development milestones without risking financial performance. Learn more at ddcfpo.com. We're actually going to have Chad Crotty, the Vice President of Sales in the North American region from DDC here in a moment to talk to us a little bit more about that IT outsourcing service. But before we do that, I did want to give us our chart of the week. We've only got one for you today. This one comes from the Wall Street Journal, data from FactSet. This is, again, commodity prices. Last week, we spoke about lumber. This week on this chart, you've got corn, soybeans, and wheat. Everything on almost every commodity line is going up crazy. Corn prices are up 50% in 2021. A bushel now costs 2 times what it did a year ago. Copper is at record prices as of last week. Lumber, as I said last week, is 4 times the 5-year average. Crude oil, highest since 2018 and likely going higher with this pipeline problem. And soybeans at their highest since 2012. So if you're looking for where your inflation's coming from, it's right there in commodities. All right, let's move on to buy or sell before we bring on Chad, JP. The first buy or sell, I did want to make an acknowledgement to one of our buy or sell last week. Zach Strickland and I did buy or sell on the rumor that Plus AI may be going public. That is happening. They are going to merge with Hennessy Capital Investment Corporation number 5, a SPAC, of course. This is the same company that brought public Canoe, Bluebird, and Dasky. The valuation gives them a valuation of roughly $3.3 billion, going to bring them $500 million in gross proceeds. So congratulations to Plus AI. Looking to hear more about that. All right, first buy or sell for you, JP. This is, of course, a rumor or a statement that I've heard. You tell me whether you're buying or selling it. Tesla is reportedly sold out for the entire quarter. Electrek reported this before market opening last Thursday that they have sold their entire lot for Q2. You buying or selling?
I buy that. They're pretty good at leaking forward guidance to Electrek and other kind of EV friendly business publications. Inventory is tight up and down the automobile supply chain, from tier 1 parts to even to used cars on the lot. And so no, it doesn't really surprise me, especially with just how much money consumers have right now. I can see that a really nice, prestigious, even though it's expensive, car can do very well in this environment.
Yeah, I agree. I'm buying this one as well. Elon said during the Q1 call that demand is the best they've ever seen. So this is kind of in line with that. Although we don't know exactly where this, where the rumor came from. It says sources familiar with the matter. But selling out is not surprising. They sell out most quarters. I think this would be probably the earliest they've ever sold out. But I'm buying it. All right, one more for you, JP. Simon Property Group CEO David Simon says he sees shopper euphoria as people return to stores. I've got the quote for you. Between being cooped up, between being locked down, between the stimulus, between celebrating that the country is still around, there's clearly some level of euphoria around that, David Simon said during the earnings call Monday. You buying or selling?
Definitely buying. I saw something really interesting the other day, Andrew, on FinTwit, financial Twitter, right? It was a hedge fund guy who posted pictures from his phone from inside the Houston Galleria Mall. It was a line to get into the Louis Vuitton store at the Houston Galleria. And it was way out the door, going down through the concourse. And what was really interesting about it was that it didn't look like a bunch of rich stay-at-home moms who shop all day long. It was sort of normal jeans wearing middle-class people who had a lot of extra money and were looking to buy some nice stuff with it. So Is that euphoric? Yeah, probably. And I think you kind of in the subtext of calling it euphoria means that there's probably a come down and hopefully not too bad of a hangover.
Yeah, I agree with that. Savings rate, I think it popped up to almost 28% in March after the stimulus round. But I'm not buying this. I'm buying that this is some sort of euphoria, but I'll call it stemforia. I think that what David Simon is speaking to was the March numbers, which were incredible. So the Bank of America.
You're saying the euphoria has been brought on by artificial substances?
Yes, it's the stimulus euphoria, and I'm saying that crash has already come. So the Bank of America data, spending in March was up 29% at department stores over 2019, but in April was down 7% over 2019. So a big reversion back down. So I think that there was some euphoria there. That we had some seasonally warm weather towards the end of March. I think people had a lot of money in their stimulus, and they did go out and buy some things, probably something nice at Louis Vuitton, but I think that it's going to wane rather quickly.
I think it's really going to be almost like whack-a-mole, seeing like where the money pops up in the consumer economy, just depending on how people are feeling with regard to the virus, the restrictions that do remain, the weather, what kinds of opportunities people see out in the economy, right?
Yeah, for sure. I think David Simon said the same thing. They're not even giving forward guidance because they have no idea whether this will persist or not. A lot of uncertainty ahead. All right, that's all we got for buy or sell today. We do have Chad Crotty with us now from the DDC Group, DDC FPO. Chad, how are you?
Great. Thanks for having me, guys. Appreciate it.
No, really appreciate you being here, Chad. Many in our industry are familiar with DDC, but for the uninitiated, how would you describe what all you guys do for the industry?
Well, essentially what we do is we provide a whole host of front and back office solutions for the transportation industry. I'd say for the most part, carriers are familiar with us for our freight billing programs, primarily because we touch about 1/3 of all the LTL bills in the U.S. But for all of our solutions, we leverage a network both of human and technological resources from locations around the globe. So today we have about 5,000 team members spread across Europe, Southeast Asia, and North America. But primarily what we do is we provide and improve operational and financial performance for our partners.
Chad, that's a huge team, 5,000 spread out across the globe. Tell me a little bit about one of the newest services you guys rolled out, something to do with IT outsourcing. We spoke about it there at the beginning. Tell me more about it.
Absolutely. So basically what it is really is a suite of services geared around providing flexibility and scalability with various IT projects. So we support short-term, long-term, and ongoing projects regarding systems development, database development, software integrations, and a wide variety of programming skills as well. So basically, whatever the IT skill requirement, we either have it in-house today or we'll recruit for it. And we'll work closely with each partner to identify the best resources for their IT goals so they can hit their timeline requirements and their financial targets.
Chad, you said that you guys are pretty well known and saturated in the carrier market. Is this new service being aimed at carriers? And if it's not, who all is this being aimed at?
I'd say primarily, yes. Carriers and 3PLs is our target audience for this. Absolutely.
And what was kind of the driving force that brought this to market? Where was the demand coming from?
Well, I think we can all agree that the demand for IT support continues to grow exponentially each year. There's several studies to support that. In fact, the Bureau of Labor Statistics reported that demands for jobs in tech will grow by 500,000 over the next 10 years. So it provides a real challenge for companies whose core business is not IT, like transportation companies, as an example. The demand for skills relating to data science, AI, RPA, software integrations, and data security are real concerns, not to mention the cost to recruit the people with the right skills. So, as an example, what I always go back to is you have a lot of carriers that are using legacy systems like the IBM AS400 system. That system's been around for 30 plus years. Not a whole lot of change there. There's been no need to change it, but you still have people that have to do the programming and the maintenance and fixing bugs and things like that. A lot of the people that they have doing programming on those systems have been doing this for their entire career. So they're either close to retirement or are retiring. So for us, it was a kind of a no-brainer because the carriers don't seem to be making a change to moving away from that technology. So maybe it would make sense to supply the resources they need to help fix those bugs and do the maintenance and things like that.
Chad, our industry, especially with carriers, is going through, a digitization and an evolution, modernization in many cases. Have you seen, has COVID accelerated that shift, and has it been a boon for you guys?
Absolutely. Historically speaking, a lot of what we do is front and back office type work. We've seen a huge spike in volume. A lot of our business is transactional. So if we're doing billing, as an example, we've benefited from that spike in e-commerce, from that sheer volume increase. So we've had to bulk up our staff to support that. And then the needs with carriers and 3PLs for IT projects, whether it's a short-term project or they need a scale to take on additional projects. We can help support that as well. So we've definitely seen some changes on all fronts.
And Chad, what should we expect from DDC FPO and the DDC group moving forward throughout the end of the year?
I think you'll see a lot more in terms of IT support. You'll see a lot more in terms of shipment volume increases and just a need for support in other areas, whether it be in offshore or nearshore environments, to free up resources to help support existing teams and take off some of that workload from some of the carriers and 3PLs that we work with today.
Chad, if anybody wants to go and find some more information, I'm sorry I've got to wrap this up, but if people want to go find out more information about DDC FPO and the DDC group, where should they go?
DDCFPO.com. You can get all the information you need, and you can find me directly on that website as well.
All right, Mr. Chad Crotty, thank you so much for your time.
Thank you, guys. Appreciate your time.
All right, have a great week. All right, JP, let's do You Care or Not. I've got two for you today. The first one is on one of my favorite serial entrepreneurs in the U.S. This guy has big dreams. His name is Mark Lowry. He is the former founder of Diapers.com, or at least the parent company of Diapers.com. He sold that for like $500 billion to Amazon, and then he was the founder of Jet.com, which sold to Walmart for $3 billion. And then he spent the last 5 years, prior to a few months ago, he spent that as the head of Walmart e-commerce. He has found his next venture. He is, of course, a serial entrepreneur, and that's what he does. The next one is a company called Wonder. It's a fleet of on-demand food trucks, but they're kind of like half food trucks, half ghost kitchen. So it's an app that is piloting in the very affluent neighborhood of Westfield, New Jersey. So it has a fleet of vans that house a chef. They've got some equipment, and they've got fresh ingredients. So they are trying to recreate the fine dining experience at home. So orders are delivered on a foldable tray with fancy dining things. But it is made in a truck that is on demand, and supposedly the salad gets tossed right before it's delivered, and the steak is freshly seared, and these meals cost upwards of $100 for four, delivered to your home. You care or not?
I care. I mean, this is really amusing to me. It's like if it didn't already suck to be a chef, like now I'll cook like in a moving vehicle as it's going down the street. It kind of reminds me of Zoom. Not the video chat startup, but the robotic pizza kitchen startup.
Okay.
Just this very sort of like kooky, food delivery concept. I don't know. I mean, I think that there will probably be a couple of like pivots before it scales. And the way I think about food trucks is like it's really easy for them to make money if they're parked and there's a line. It seems like the unit economics of driving around from place to place, I would just need to see more. What are we talking about in terms of price?
I'm with you.
Are we talking about like $1,000?
We're talking like $100+ per dinner, and you're expecting, and they apparently sell out pretty quickly. They're scaling quickly in the Westfield, New Jersey market. Apparently, there are people that live in the neighborhood that are kind of worried that it doesn't seem like a pilot anymore because these trucks are everywhere, and they apparently sell out pretty fast, and they're in high demand. But I can only imagine they sell, maybe like 20 meals out of each.
Also wonder about utilization too. Like the thing with a parked food truck is that you show up where the people are, they line up, you hit peak like rush,
right,
and then you're done. You pack up and go home. But how many orders, how productive can you be by driving around during peak, basically?
Yeah.
It seems like a disadvantage, but of course it makes sense to me that they're trying it out in an affluent place where
Yes.
people, probably don't know what else to spend their money on.
Yes.
They've ordered everything they can on Amazon.
Correct.
And now, yeah.
Yeah, Mark Lowry himself is an affluent person, and he's very busy, and he is trying to solve for rich people problems. I mean, he's trying to give rich people more of their time back, and apparently, I don't know much about this town in New Jersey, but apparently it's home to a lot of transplants from New York City. They moved there to build a bigger house.
Yeah, people who commute, yeah.
Right, and so, he's trying to go for that market of people that, want a bigger house, want to live outside of the city, but still have that kind of taste for fine dining that they can't get in Westfield, New Jersey.
Man, this is really hey.
It's a very niche problem he's trying to solve here.
Mark Andreessen said it, right? It's time to build.
Facts. I'm excited to watch this. Chad Lowry, his brother is involved, and apparently he's got the ex-chief revenue officer from Walmart e-commerce. That's the CEO. So he's got some big names and some talent on this. And I am going to watch because I hate takeout food. Like, I never get takeout food because it's always soggy. No matter if it's even like a 5-minute walk, I can't stand it. So I never get takeout food. I would be willing to try this just to see if I could get something at home that is like certified. You
watch,
fresh.
Dude. But by the time Series C happens, they're going to be launching crystals out of a pneumatic tube.
I can't wait for that. It's going to be awesome. I hope I live in an area where this is one day available. I mean, I don't see Chattanooga as the next expansion.
It's kind of cool. I mean,
but
it's a cool idea.
Cool. All right, one more you care or not before we hop into some brokerage earnings. This is on autonomous truck maker TuSimple. They reported first quarter, well, I would say earnings, but they didn't earn anything just yesterday afternoon. Their first quarter loss, though, it widened to $385 million from a loss of $25 million a year ago. You care or not, JP?
I care a lot. To me, it tells me one thing, kind of in particular that jumps out, which is basically like, hey, they're actually building stuff.
Yeah.
No one, at least in 2021, no one thinks that autonomous vehicle technology is going to be cheap. It's actually very expensive. There's a lot of people trying to invent this wheel for the first time at the same time. It really all, and whether you think losing $385 million in 90 days is bad or good really just depends on how much cash they have on the balance sheet. And also, I would think, the actual valuation of the company and the ability of the management to issue new equity at a really attractive price to raise more capital.
Yeah, I agree. I do care about this one for a bunch of reasons. I'm very excited about autonomous technology. We've talked about this ad nauseum. It is very expensive. I mean, that if you could look at Uber or Lyft selling off their divisions, I mean, we've seen Starsky and a bunch of other very promising startups not make it to the next funding round. As for cash on the balance sheet, they've got, I think, $1.5 billion after the $1 billion from IPO. So if they kept up this pace at this revenue generating pace, which was they only generated $1 million in the first quarter, they've got like 5 quarters of burn. But next year they're projecting $500 million in revenue. So who knows if they get to that? But it seems like they have a runway, is what I'm trying to say.
Yeah, they have a runway. I mean, one of the things that makes autonomous vehicle technology so risky, and the reason why we've seen such a proliferation of joint ventures in this space, is because it's one of those things where it's not like building a car, right, or building a car for the first time in the 19-teens and 20s, where this car sucks, but someone's going to buy it and it'll work fine, and we'll keep making them better.
Right.
There's kind of this thing with AVs where it's like, until they're actually autonomous, especially for commercial vehicles, until they're actually driverless, what's the economic benefit for the carrier or the shipper, right? So you have to. It's not a case where you can introduce a minimum viable product and then keep iterating until you have something that's great. You really have nothing until it's perfect.
Until it's 1,000 times safer than human driving, right?
Yeah, even 10 times safer, right? So that's what makes these things so risky, and why TuSimple will be a company to watch, because it's a pure play. They're public now, and I think there'll be a lot of really interesting data coming out of this company. I
liked one thing that I heard in the Q1 earnings call. They added a bunch of headcount. They're up to 970 employees. 84% of them are in R&D.
Wow.
I feel like that is a good. I don't know any industry numbers, but that is a good number.
So the way to think about this $385 million quote unquote loss, I mean, it's probably all essentially capital expenditure, right? This is the investment that the company is making to build its main product.
Yeah, I think Cheng Lu, the CEO, he spoke to how the money is already making a huge impact on their recruiting and the IPO in general, just kind of giving them a name brand that's recognizable. Because they've got to pull talent from Google, from Alphabet, from like all of the best places if they really want to compete here. So I'm excited for TuSimple. Definitely be watching them. All right, let's hop into brokerage earnings. So we're going to talk about C.H. Robinson. We talk about Hub Group, and if my computer will work, well, let's talk about C.H. Robinson. So we'll go some top line numbers. Adjusted gross profit up 24% year over year. EPS blew out expectations. If you had to describe it in one word, what would it be?
Great quarter, guys. Right?
There you go.
That's not one word. That's 3 words, but it feels like one word, right? I think they had a little bit of share buybacks. Obviously, Robinson has a dividend, which you can kind of put on top of the EPS, right? If that's the way you think about stocks. Really, a couple really interesting things that I actually like about Robinson from this quarter. One is that truckload volume was down. Now, why would I like that? I've always been a critic of the message from Robinson management that they're taking market share, that they're growing. They always say that we're growing sort of faster than Cass, right?
Yep.
That's what they always compare themselves to. Of course, Cass is probably heavily weighted towards CPG and industrial, not a ton of retail. I always thought it was kind of a questionable benchmark, but in my mind, Robinson is the dominant player in North American truckload and LTL brokerage. It has no reason to be gaining share. I don't really think that SMB shippers, for example, are its target audience. I think it should really act like a railroad. It should double down on its technology and its relationships to sort of firm up its moat and really care mostly about margin and productivity. Last quarter, they started releasing shipments per person per day in the NAST, or the North American Surface Transportation Business Unit, which includes LTL, TL, and intermodal. That data has been super interesting. It makes me wonder, to what extent shipments per day per person is sort of artificially inflated. If you're growing LTL but you're shrinking TL, that implies more shipments per person per day. Yeah. So I wonder if they measured productivity in terms of net revenue dollars per person per day, what that would look like. It'd still probably look pretty good because of rate inflation.
We do have that chart if production can toss it up from the C.H. Robinson. Yeah, so I think this chart on the right is the one you're speaking of, NAST shipments per person per day, and you can see that arrow there. Since that announcement of the $1 billion investment over the next 5 years, either some very timely announcement there, or you're seeing some, you're actually seeing some productivity gains. And yeah, you're probably right. It certainly could be artificially inflated a little bit if they're having LTL shipments.
But I like where management's head's at now. They're emphasizing the fact that NAST headcount is down 7 quarters in a row. Right, that's like something that Union Pacific would say, and they would pat themselves on the back for it. Right.
Right.
That's something that a mature company that's really focusing on operating margin and really finding what's the best freight for this company at this moment in the cycle, and how can we execute it with the fewest number of people. So that honestly, I think some people were a little surprised by especially truckload volume down 5% year over year, but I actually like that, and I think that's what they should be doing.
It's 3 sort of 4 quarters. Right?
It's almost it's almost like what Carol Tomei is saying about UPS, better, not bigger.
Right, not growing at all expenses.
And I think that Bob Biesterfeld, the CEO, and the rest of the management team really still needs to fully articulate that case to Wall Street and kind of explain why they think that they need to focus on sort of revenue management, not necessarily growth at all costs. They need to focus on what they do better than anyone else, which includes highly tech-enabled, intimate supply chain partnerships that go downstream to the consumer and upstream through the supplier network. And of course, global forwarding is another standout. And there's plenty of white space left in in the in the globe for them, right? I think we'll continue to see acquisitions from them, just buying forwarders, really wherever they can find them. I mean, they've bought them in Europe, they've bought them in Australia before. So looking forward to seeing where that goes.
So overall, good things, right? So
Yeah.
we got NAST headcount down, productivity up. We've got, it seems like they're being more selective about freight, which has been a headwind in recent quarters. But let's move on to Echo for a moment. We've only got about 5 minutes here. We'll try to touch on Echo and Hub Group. Top line, what do you got? Takeaways from Hub Group, or from Echo rather?
Yeah. So I mean, truckload revenue was up 45.3%. Which is great because they managed to increase truckload volume by 33%. So they're raising prices by double digits to their customers and also growing volumes by really, really strong numbers. Echo's a much smaller company than C.H. Robinson, and Doug Wagner still wants to prove that he can grow this company fast, especially when he sees a pitch over home plate, right?
Right. Are you? So Basco Majors of, I always mispronounce this. Is it Susquehanna?
Yes, Susquehanna.
Okay, Susquehanna. So he wrote that he believed that 2021 will be the cycle's peak for Echo. Do you think that is solo to Echo, or do you see that kind of spilling over across the brokerage space?
I think that it really depends. I think that from a revenue and sort of contract rate perspective, probably. Although to some extent, those contracts are going to be, if all of 2021 is strong and the market doesn't start falling apart in Q4, then that has good implications for contract rates going into 2022. I do think that 3PLs benefit from a gross margin perspective on the sort of the back half of the cycle when spot rates are falling faster than contract.
Right.
But that hasn't really affected the stock prices of these companies. It seems like the street is mostly focused, I mean, probably as they should be, on revenue growth and earnings power. So even though all three of the 3PLs that we kind of cover, or we cover more than three, but in terms of surface transportation, Robinson, Echo, and Hub Group, they all saw margins come in a year ago, but it doesn't matter.
So not something you're worried about? You think it's just part of the cycle? I mean, we should be reaching a point here in the back half. Well, many are expecting the back half of the year to see, some kind of deterioration here, some type of moderation. At least that's what we're hoping. All of these, from all three of these companies, Hub Group, Echo, and CH, they all kind of gave expectations that this market should stay tight through the end of the year.
It'll stay tight, but not at peak spot rates, right. which have come down a little bit since the end of March.
All right, so we got about a minute. Let's just hop and give some headlines on Hub Group. So Basco Majors, we read his report on this one. His thesis is that, yes, there is more potential for growth ahead in 2021, but he's a buyer because he expects the material growth to persist into 2022 because of Hub Group's leverage to intermodal volume pricing and such.
Yeah, I think everyone knows that the railroads have a lot of power over the situation at the ports and the terminals. Especially they have a lot of pricing power, and I think the street is also probably has one ear to the ground on what the railroads are saying about their expectations for intermodal volume growth. Especially when you listen to like Norfolk Southern, for example. So yeah, I think intermodal is the story for Hub Group. It's the biggest part of the business by far. It makes their margin profile a little bit less attractive. 11.8%, but we've already talked about how the street doesn't care about that so much. It cares about revenue growth, right? And that's why Hub Group is trading at all-time highs right now.
Yeah, we got a lot of the brokerage space trading near all-time highs right now. Been a good first quarter for them so far. That's it. That's all we have for episode 69 of Great Quarter, guys. You can join us again next week. We're back at our normal time, live 3 p.m. Eastern on FreightWaves TV, FreightWaves LinkedIn, and FreightWaves Facebook. I'll be with Ethan Chernovsky, who is the VP of Sales at Placer AI. We're going to be talking about the retail recovery from a foot traffic perspective. They've got some of the best foot traffic data in the biz. Remember, you can subscribe to Great Quarter, guys, anywhere you listen to podcasts, and also subscribe to Freightcast, wherever you listen to podcasts, Apple Music or Spotify. We'll see you again next week. Thanks for joining us. you.